I'm
Kendall and
very
I will be in
excited
the
to be here.
background if you need something.
Yes, sir. I'm very excited to be here. Thank you guys for having me, and we'll give her our best shot. I've got about 100 slides to cover in 45 minutes, so I appreciate your. If it makes sense to hold the questions because we're going to kind of go fast, and but obviously make sure you write them down, and we won't pass you up, right? So
Great.
thank you guys. I'm really honored to be here.
Glad to have you.
Okay, I'm going to share my screen.
Great.
How about that?
No, yep, there you go.
All right.
Okay, we'll be in the background.
Thank you, Don. Thank you, sir. So I'm really honored to be here. We do really well with certain connections in the business, and certainly Don's group and the influence that you guys have been given, the vantage point you guys have been given is really good. And so um, the title of my presentation is Unlock the Wealth, Note Cycle Mastery over Rentals, and we're going to really address that. Um, I'm not poo-pooing rentals, but I can tell you this, and I've been in this industry since 1980, and I've been around a time or two and been around the industry a lot. Uh, right now, we are definitely in a note cycle that is different than a real estate cycle. And so it just kind of is what it is. There's nothing to be negative about that. It's just to be aware of it, and we're going to have a lot of evidence of why that is true. So like Don, I'm going to do you a legal disclaimer. This is for educational purposes. I am not an attorney. I'm not a CPA. I have paid millions of dollars in fees to those guys. So I think I'm somewhat knowledgeable, but I'm not a licensed professional. And so anything that we say here should be verified and confirmed with someone that does have a license in those areas. So a little bit about me. I have 40 plus years in the note investing business. We have perfected some note techniques that are unique to the industry that we just been around a long time. I'm kind of an old guy. And so we've been around a long time. I have bought 50,000 discounted notes. So we're still in the space. The biggest thing you could compliment me by saying is, Eddie, I appreciate the fact that you guys do the business. You're not teaching something that you have never done much of, or you're not teaching something you don't do anymore. No, we're in the note business, and this is kind of our thing. So we're going to talk a lot about wealth building, and I think you'll see that. So, really unlocking the secret to time efficient note investing. Number one, we're going to show you three principles today, and we're going to show you these quickly, but we're going to show you them in a way that I think it'll make sense. First of all, long-term note investing with immediate returns. In words, you don't have to wait to get paid tomorrow. You can get paid today, and that's one method. The second method is to create cash flows, and this would be future cash flows, but do it with a very minimal capital investment. And we're going to show you some leveraging techniques that are fairly unique to the business. And then the last thing is generate returns while others wait. And so many times we've seen people with other real estate investments, and they're just hanging on. They're hanging on to that future so they can then get paid for it. And we're going to say that I don't believe you have to do that. And you can use these note techniques to do it. So we'll apply these concepts, and you'll see us kind of enter them as we go into various case studies. So first of all, what you're going to learn tonight is you're going to learn cash flow versus wealth, or both. Like, you can do both in the business. So first of all, we have the perfect storm for note investing. I started in the industry here in 1980. Interest rates were 18%, and banks and mortgage companies were essentially out of business. They weren't doing well. And what I learned then, in every cycle that I've lived through since then, is there's one truth that is always absolute, and that is when the banks are in trouble and having troubles, notes do really well. Private notes do really well when the banks are struggling. And if you've done your Google research, You know that the banks are definitely having issues today. There's a gigantic target list that the market is worried about, and I agree that there are definitely concerns with that. So we'll talk about that as far as that's concerned. But let me just say this: you can't fight the market. You can do the perfect thing in bad timing, or you can do an average thing in perfect timing. The second will excessively outweigh the first every time. So, unlocking the success, and we're going to talk about three pillars of the business. First of all, is timing. That is where we're at in the market, doing the right thing at the right time, right? Secondly, is your time. I appreciate the fact that you guys are busy professionals at doing various things in your life. And the most precious thing that you have, quite honestly, is your time, that I have in my life is my time. And so your time is a variable. And then the other thing is other people's time. And the other people's time is like, how can you get somebody to do something for you that they are more positioned to do? They're waking up every day and that's what they focus on. And it just doesn't take up your time. So we're going to talk about those three variables a lot and how they really relate to this business. So first of all, the most important thing is your time. Everybody agree with that? Like your time is the most important thing, no matter what cycle you're in your life, right? If you had the most important thing that you could have more of, wouldn't it be time? So we're going to talk about like time efficient investing and time efficient management because the note business gets a gold star for that. It takes less time to do this business, and we have some techniques that we've developed that take even less of your time. So that's a big factor. So you probably struggle with at least one of the challenges many people seem to face in real estate investing. So here's the big three, right? Number one, you have a job, you aren't able to devote much time to real estate, right? You don't have time to go grind every day. Number two, you have a nest egg and you want to make it grow, but quite honestly, you don't know how. You don't know where the next turn in the market is. You don't know where the next opportunity is. And so this is something that I think will really help you. The third thing is you want cash flow and investment income, but you don't trust the banks or the stock market. Now I'm that. I'm number three, right? And 44 years, and I've got hundreds of thousands of hours learning this business. I like to control my future. Here's what I'm going to say about notes. Notes are the best in-between product. Those of you that like investing in syndications, right? Because they do the work for you. But the problem is you don't control anything, right? You don't control their decisions. You don't control what decisions they've made. And so you got your money invested and you're betting, you're hoping that they're right. Sometimes they are, sometimes they aren't. I'm not saying anything against good operators. I'm just saying not everybody that does syndications is a good operator, right? And the market's not very kind to them at the moment. Then on the far end of the spectrum, you have rental properties. Well, let's just be honest about it. You may have more control than you want, right? When you buy a note, you own the note. Somebody else doesn't manage it. You own the note. You control its future. Now, you may outsource things, but you have the final say of what happens, right? You can own 1,000 notes or 55 rentals for the same amount of work. Let me say that again. You can own 1,000 notes or 55 rentals, both equal the exact same amount of work. So, with that being said, people like notes. Okay, so let's say that you got this big pile of cash. Let's say that you have $250,000 in investable capital and you're like, okay, what do I invest in? What does it look like? Well, you like real estate as an alternative investment. I like real estate as an alternative investment, right? So you like the idea of real estate, but reading the signs to the key market factors are a big thing. When do you buy, right? When the market's down, you buy. When real estate's on sale, you buy. When do you hold? When do you hold up? When there's a caution flag in the market. And then lastly, when do you sell? Like, when is the market telling you it's time to sell? Like, those are the variables that I find most investors are looking at and paying attention to and cognizant of in the marketplace today. So I live in Dallas Fort Worth. Um, and Dallas Fort Worth is a good example market because it's the middle market. It's not Toledo, Ohio, and it's not San Jose, California, right? In other words, the value of property compared to the dollars per rent, a $250,000 house in Dallas Fort Worth will rent for about $1,800 a month. Now, that's not even 1%. Used to, that people would operate off of what we call the 1% rule. Well, that we're not there anymore. Houses have gone up in value so much that 1% is probably uncommon in most markets, right? Or you could buy notes. You could buy a real estate secured first mortgage on somebody's house, and now you're the bank. Now you're entitled to collect the principal, you're entitled to collect the interest, you get the monthly payment, and let's just say that you buy a note, and for that note you pay $250,000 for that note. It could be one or more, right? I like buying first mortgages. I bought 50,000 of them, right? Pretty good business for me. But I'm going to show you what people have shown me about how they look at it, comparing the two assets. So why do people like notes? Well, first of all, the comparison is you have a rent house. Let's be honest about it. If you have rent houses, they're probably more stressful than you're hoping for, right? And that's a pretty common thought. Secondly, is people don't like the cash flow on rentals today. You see, it's kind of a math lesson. Expenses on rental properties went up by 60% since the virus. 60% since the virus started. Rents went up, but they didn't go up 60%. Rents went up about 25%. Sometimes markets have settled back down because they've actually gone down. They're at about 20%. 20% increase in rents, 60% increase in expenses. See, that's not very good math. That's what's affecting people's cash flow. And the last thing is, if you're going to buy rentals today, you have very little cushion, right? In other words, if you buy this rent property and it doesn't work out the way you thought, then you probably are going to lose money if you try to go sell it quickly, right? So it's kind of like it doesn't have a lot of flexibility in it in that regard. So here's notes. Way less stress. What did I say? You can own 1,000 notes or 55 rentals for the same amount of work. I believe that to be a truth. Secondly, way more cash flow. Way more cash flow. And then lastly, you have a better cushion. So we're going to prove out some of these theories. First of all, you ever know any landlords that feel like that? That's a factor. That's definitely a factor. Secondly, let's talk about the income side. So we have a rent house. That $250,000 house in Dallas, Texas rents for $1,800 a month. I've done a lot of training for several real estate brokerages. Literally this week, I have a very large real estate brokerage I'm doing a very similar training to what I'm helping you guys with. I've done a lot of training for Keller Williams, some of the most advanced and successful realtors in Keller Williams. They give me these numbers, so I'm operating off the advice and the information they're giving me. $1,800 a month is what it'll rent for. The expenses are $900. So 50% of the income on rent goes out in expenses, taxes and insurance and maintenance and all of those variables, vacancy. Unfortunately, that's a sad truth, but it is. You get $1,800 in rent, but $900 of it drifts away from you. It goes out to expenses. So you're going to net 900 bucks. You look at a note for 2,700, a $250,000 investment gets $2,700 a month in income. That's the average income we see on a note. Now we are deep in the note space and we trade a lot of notes, so we know what these numbers are. Notes have excessively better cash flow. Okay, well, you got a loan servicer and he's going to collect the payments for you. Take out 32 bucks for that, and you're going to net 2,668 bucks. Almost $2,700 versus 900. That's almost three times. That is about the math. That is about the math. About three times. If you net $1 in a rental, you net $3 on a note. That's about how the math's going to work. So let's look at some examples. These are actually notes that note school students bought through us this year. This is a property. Now it's in a lower price band market. It's in Mississippi, but the house is worth $85,000 and it's clearly well kept and a nice property. This note costs $56,000 and the cash flow on it is $607 a month. This is a property in Texas, right? It's a $115,000 house, and the cost of the note was $84,000, and its payment is $845 a month. So you see, we're at 1% or more. Look at this property. This is up in Indianapolis, and this is a property that's worth $185. This note is cheaper. It cost $137,000, and look at the cash flow. The cash flow is $1,982 a month. Do these properties bother you? Does this look like junk real estate? Do these look like people that don't have pride of ownership? I'm not saying they're not, some of them aren't working class people. I'm just saying to you that I buy notes on nice properties where that property will fulfill the dreams of the buyer. That's my litmus test. So Warren Buffett said, if you don't find a way to make money while you sleep, you will work until you die. Well, that doesn't sound very promising, Mr. Buffett. So I think I'll try to find a way to do that. This is Jay Redding. He lives up in Indiana. And he said he likes the notes because it's created short-term and long-term cash flow. And that's some of the examples I'm going to show you here today is that it is those strategies plus he's created some wrap notes which have produced chunks of cash because he's gotten down payments. And all of that has led to a predictable income. Now, he's a very seasoned landlord from the past. He's not an experienced real estate investor. He's very seasoned, and that's what he's seen. So kind of our discovery is this. Completing note deals faster while using less of your own time is the key to seizing opportunities and building wealth quickly. So what's kind of new in our world? Note School's been around about 25 years. Note School has had thousands of people that we've helped invest in notes. And so we became very curious and very interested in how we could help people do better in the business. So in the past, we've had courses and training and coaching, and we're solid at that. We know this business pretty solid. I appreciate Mr. Don's words. I believe they're true. I think we kind of know the teaching of notes better than anybody because we just we're like that insurance company. We know a thing or two because we've seen a thing or two, right? We're that, right? And a student would come back and then say, I'm trying hard, but I'm getting nowhere. And what am I doing wrong? And the answer is we really did an analysis and said, well, there's many things that could be fixed about this. Now, the guy on stage there is actually, Don knows him. And he's our chief marketing officer, and he is a very curious person. And so he started on this trail of saying, okay, what if we did done for you? Let's run a test. So these were our highest end students that we had a special event, our most elite students. And you can see they're just working people, they're not dressed up in tuxedos, but they're smart people and they have investable capital and they want to do this. And we said, what if we could help you this? What if we offered done for you? And I'm telling you, the response was overwhelming. Like almost 90% of the people said that was a big deal. What does done for you even mean? We believe it's your secret weapon. First of all, deal sourcing. I bought 50,000 notes. You think I have a seat at the table in the industry? Now, Don's been to events that I put on. He knows that to be a truth, right? Secondly, is due diligence. My bench has a lot of experience, right? We have a lot of experience doing the business, and we've developed a nose, a smell for the business. And then lastly, various asset management things that we do to help people do the business. What if you could rent some of our back office to make it better? And so that's what we offer to our members on a long-term basis. And they really got that, and they thought that was a great idea. So it's the best thing maybe we've ever done in the business. We only did this a couple of years ago, and we've really progressed and tested it since then and made it better. So let's look at a case study of other methods. This is an actual note that one of our note school members bought. Now, this property was located in Dallas, Texas. And, we have a saying in our business, there were roses in the flower bed. You see that? You see that lady's roses in her flower bed? See, why that matters is because they have emotional equity in that property. Now, that property is worth $185,000. Okay. That note cost 125. So that means that your investment compared to the value of the property is 68%. Remember me saying there's a cushion with notes that rental properties don't have? Well, we'll get back to that in a second. Okay. Look, I'll admit to you that yield to some degree is country club bragging rights, right? People want to know what the yield is, what their rate of return is. And sometimes if I handed them a calculator, they couldn't exactly figure it. But this is normal that our students would get 11.5% yield or interest on their investment on an annual basis. Compared to a rent property that's probably yielding 4 or 5, that crushes it, right? So, and you say, well, okay, well, who owes the money, Eddie? I'm like, are these people going to pay? Are they really going to pay? Well, look at their credit scores. They bought it with 10% down, and look at the balance that they owe today compared to what it's worth. They've paid that loan down because they're paying early every month. See, they only have 156 payments remaining. They started out about 2 or 3 years ago with 20 years. They've cut 20-year term down to 13 years because they're paying the loan early, right? It's a working class neighborhood. I'll take this customer any day of the week, right? Let's look at some risk on this. Is it less stress than owning a rental? The answer is Captain Obvious. Yes, of course it is, right? The loan servicer services the loan. There's really not much for you to do, right? Is there more cash flow? Well, we'll run an analysis on this in a minute, but I'll bet you the cash flow is close to 3 times what it would net if it were a rental. 3 times. And then there's a better cushion factor. This note costs 125 and the property is worth 185. A lot more cushion than owning a rent property. So let's do this analysis. This note cost $125,000. If that were $125,000 rental, assuming it was in a good, safe neighborhood, that would just be what the property cost. It would rent for about $1,100 a month, $550 to go out in expenses, and you would net $550 a month. Well, we know because of this asset, the income is $1,557 because that's what the payment is on the note. You got a servicer fee. You're going to net $1,525. So look at the left. This is 1, and this is 3. 550 or 1523. 1 to 3. That's kind of what the math is on notes, right? It's not always the same exactly every time because we buy different terms of notes, but people definitely like the cash flow. Secondly, let's look at the cushion factor. So you buy a note and the property's worth 185, but you invested 125. So there's a lot of cushion between you. There's a lot of cushion between you and what you invested in the note versus what the collateral's worth. But if we look at the property value thing, we've got the note on one side and we've got a rental on the other, right? If you bought a rental, you'd pay about 125. Where's the cushion? Where's the cushion? It's not there. There's $50,000 cushion on a note that a rental property, if you bought the same property, same comparative investment. And so those are three big factors of why people like notes versus rentals. Now, I'm going to get fancy with you for a minute. We're going to analyze some numbers. One of the three things that I told you is that you get long-term notes equal immediate returns. You do not have to start waiting getting your money back. So many investments are cross your fingers. I hope I get my money back in the future. So you buy this note, the payments are $1,557, 156 months. The note costs $125. Listen, in cash on cash return, you get $93,000 of your investment back in the first 5 years. The first 5 years, look here, you get 30,000 of your principal back and 63,000 thereabouts, just a little less than that, in interest. What would it take for you to get all your money back? Well, if you looked at your investment of 125, it takes you 81 months. So how much goes to profit? Well, you have $116,800 in profit over 75 months at $1,557 a month. I'll compare that math to a syndicator or to somebody offering rental properties every day of the week. This is real math on a real case study of a deal that we just traded to a student within the last literally 60 days. So this isn't a 70s example. This isn't like it's right now. This is what people are doing today, and this is why they like it. Emily and Adam, very smart young couple, and they were in syndication business, good operators, smart people. I respect them immensely. But they were managing a whole bunch of apartment units, and all of a sudden the cash flow evaporated. And so their steady income that they were making to be in that business every day evaporated and went away. They came to note school because they had to find an alternative. So they came to us and they started out of the gate. They bought 5 notes, funded $250,000, and are getting $2,900 a month. Now they have now grown that. If you look here, they've grown that from $0 to $6,000 a month in their first 6 months. Okay, but this shows you they used notes to make a living when their other real estate investments were evaporating as far as cash flow. They're sold. They believe it. They're happy they're doing it. All right, so let's just say that I can sell a pizza or it costs me $12 to make a pizza. Okay, this is my cost. How can I make a profit? Well, Eddie, you could go sell it for $20. Okay. How else could I make a profit? Well, Eddie, you could take that pizza and you could sell it by the slice. Whoops. Sorry about it. You got to see this now. There you go. What if I sold it by the slice? Have I now recouped my investment? Well, what does this portion of the pizza cost me? Well, Eddie, that's free because you've already recouped your investment. Well, it's not exactly the same, but it's pretty dang close. If you can do it to a pizza, you can do it to a note. So let's take the same note, 1557, 156 months. We invested 125, and let's turn around and let's sell the first 109 payments to a passive investor. And then we own the back 47 payments of that note at $1,557 a month for $1,000 investment. See, the passive investors are getting about a 7% return, which is very substantial and doable in today's market. But see, we get 1557 times 47 months. Yes, that is 73,000 bucks for $1,000 investment. Put that in your calculator. $1,000 turns into 73,000. That's a leveraging technique. That one of many, many techniques that we teach in this business, and that is how to use cash flows and notes and carve them up to accomplish what you're trying to accomplish, right? So let me show you legacy, because a lot of us would love to have legacy, and we think to have legacy, or in order to accomplish that, we think we have to have mega millions of dollars in the bank. Well, that's not necessarily the case. This is my tribe. This is actually my family. And the pretty lady in the middle in the black dress, that is Martha standing in front of those two grand boys there. That is Colt and Levi, right? And so my wife's dad got us started in the business, and we learned this from a young age. And so, so Martha's mom's a widow. She's been a widow now for 27 years. That's Nana. That's the sweetest person I've ever known, right? And she's very elderly now, though. But she has relied on the things that we've helped her do to stay in this business for all these years, because the guy that originally taught me the business, Mr. Shoemake, sadly passed away at 59 years old. So there's Martha. There's my son Wood, and there's his son Colt. So that is 4 generations doing this business. And so now we took 3 strategies: various retirement accounts, health savings account, HSA, health savings account, and then Coverdale educational accounts, right? So we've helped her invest in her retirement. Nana can also invest in little Colt's Coverdale educational account, right? She can also invest as well as Martha can and Wood can. Martha then invests in our retirement and our kids' retirement. We obviously have an HSA account because that's the killer thing that everybody should do. Then she can also invest in all of the grandkids' Coverdale educational accounts. Now here's Wood. Yes, Wood can have an HSA and does. He can have a retirement account, and then he can also invest in his son Colt's Coverdale educational account. Where's Colt get? Well, he's getting the benefit at the moment. By the way, that Coverdale educational account is totally assignable. So if Colt doesn't use the money, you can move it to the next beneficiary. So the money's not lost no matter what happens. These strategies are very, very effective if you have a unique thing like investing in notes, and particularly selling partials, because you can take low investment dollars and turn them into crazy big dollars. Here's a case study. This is a property in Memphis, Tennessee. House is worth $220. Loan balance is $160. And the buyer has quite a bit of equity in it. So that's what we'll say the buyer's equity is about. They owe about 73% of what the house is worth. And the loan balance. So this is a low interest rate loan. So people say, oh, well, Eddie, I don't know if I really want to buy that. That's only a 6% interest rate loan. Well, and it's pretty long term, right? It's 271 months remaining. That's over 20 years. Well, we buy this loan, but we don't pay the balance of the loan. We buy the note at a discount. And we bought it at a discount, and we paid $105,000 because it was earning a 6% interest, and that wasn't a high enough return. We wanted to be able to earn more. Now, this note cost $105,000, but if you're just my mother-in-law and you just don't really need leveraging in your retirement anymore, your mailbox just gets bigger and bigger. And over the life of the investment, that 105,000 turns into 292,000, and that's been a really good deal for my mother-in-law, Nana, right? So it depends on somebody's situation and their circumstances, right? Here's a couple. This is Eddie and Irma, and they invested $90,000 in a note that they bought through our Done For You service, and they're getting $1,234 a month. So a $90,000 investment is getting them about $1,250 a month. Yes, they've had rentals. Yes, they've tried all that. They're like, Eddie, we get a check and no aggravation. We get a lot bigger check and way less aggravation. So they they kind of like this deal, right? So Martha also uses this split the pizza model, right? She also uses this very technique. And so she does that to create cash flow with minimal capital. She uses all these various accounts, and she's taken small amounts of money in these various tax advantage accounts and turns it into a whole lot of money. So she uses this strategy. She pays 105,000. She sells 143 months. And look here, she had a $105,000 investment. She sold the partial for 104,900, which means she has $100 invested to own the back 128 payments of that note at $1,081 a month. Now, we've done this quite a lot. We've done this in a lot of accounts quite a lot. And the answer is it has worked out really well for us because Martha has been able to build legacy and wealth without having to start out with a huge pile of money. She doesn't need to start out with millions of dollars. What you actually start out with in this case is creativity. So there's the passive investor, and there's Martha. The passive investor has 104,000. He's going to get 143 payments at $1,081 per month. Martha has $100, and yes, she has to wait for her money, but look at the cash flow it produces in that regard. So pretty solid deal. Next concept, the rental cycle versus a note cycle. When does it make sense to sell? Remember me saying that in the earliest part of the presentation? There's a time to buy, there's a time to hold up, and there's a time to know when to sell. When do you sell? Well, let's look at this analysis. So there is a very, very well-known website, social media platform called Bigger Pockets. Well, apparently they've been watching Note School TV because I've been saying this way before they've been saying it. But they came out with an article right at the first of the year, and they took 19 cities and they compared rents to people's mortgage payment on the identical house. And so they define their formula. They define how they calculated it. I built out a spreadsheet and I ran all those numbers. Now, I'm fully aware that the Mortgage Credit Availability Index is an index that basically says what it takes to qualify for a mortgage has dropped like a rock. You see, it was about 185 before the virus, and today it's about at 100. That is the tightness of how credit is. People need alternative forms of being able to do it. Just because you can't qualify for a Fannie Mae loan or a Freddie Mac loan does not make you bad. And it doesn't mean that you have bad credit. And it doesn't mean that your relatives won't loan you money. It's just how tight credit is. And a lot of people kind of know it, but they really kind of don't know the data. I'm just kind of showing you the data to support the situation. So I built a spreadsheet out like Bigger Pockets described. And I took rent in those 19 markets, and I took people's mortgage payment on those 19 markets. And I'm going to show you how to generate returns while others wait. Because a lot of people are crossing their fingers, hoping it's going to work, when you could sell your rent house and owner finance it and get way more money than you can probably ever get waiting on the rental property to convert in the future. It's a market fluke, but it is what it is. Okay. So I took the three most important scenarios: the income, the expenses, and the net income on a rent house. Yep, right there. According to Bigger Pockets, these are their numbers, not mine. House in Dallas, Texas rents for $1,764. Okay. Mortgage payment on that identical house on a non-QM mortgage is $2,447. $1,700 versus $2,400. Your mortgage payment is higher than you pay for rent. Then I took expenses. So I took 882, which was 50%. On the servicing side, I took out $30 for the mortgage servicer. I came up with a net income on the rent side of 882, which was 50% of the 764. I came on an income side for a note of 2417. That is $1,535 more income to seller finance versus rent. Oh, and by the way, just to be clear about this, you sold it up front and got a down payment of $62,000. You see, this is what I do. I help people with financial modeling. I help realtors and real estate investors and doctors and lawyers and Indian chiefs, people that are busy doing what they do well every day. And I help them with things that this is what we do well every day. We are in a note cycle. And it's just math. That's what I tell people. It's just math, right? It's no trickery. It's not any kind of, there's nothing hidden. It's just, these are what the math is. And every real estate economist out there has acknowledged the same variables that I've said. I've just said, when your mortgage payment is that much more than you can rent for, it seems like the data you should be in the mortgage business. So what we've learned is creative financing fills a gap that conventional lending doesn't fill, right? So when third-party lending money is cheap and easy, not many people do creative financing. But when it's expensive and scarce, a lot more people do seller financing type. We call them the penalty box buyer. It doesn't mean that they're bad. I do not buy notes on junky property, and I do not buy notes on questionable people, right? So I'm very seasoned at this. I'm disciplined, but I've learned that the market has a big gap in it and we can take advantage of it. One more quick study before we pull this together, okay? Non-performing notes. We also help people with this. We also help people find them. We also help people evaluate them. We also help people manage them. This is a student. This is Sophia Jones. She buys a note. She lives in the Baltimore area. She buys a note in Florida secured by that house. The people, you're not reading a typo. They haven't paid in 10 years. Nice neighborhood, well-kept property. She bought a first mortgage on the property. She paid for the delinquent note. She paid 29% of what the property was worth. So God forbid she had to foreclose. Would she be in good shape? Yes, Eddie, she would be in great shape. So her total invested was $94,000. So what happened is she had a servicer and they sent a default letter and told the borrower, you're in delinquent and we're fixing to foreclose. The borrower requested a loan modification. So the borrower paid $25,000 down just so that she would be willing to modify the loan. And this is the loan that she modified. She modified $120,000, 7%, $800 a month for 30 years. 360 months. Oh, right here, the borrower comes in and makes an additional $27,000 principal reduction. $25,000 for modification, $27,000 literally just a few months after she modified. She's gotten 50,000 of her investment back, which was 94, and she gets $800 a month forever. Yeah. So a lot of people like non-performing notes too, particularly when we can help them. So her annual income on this deal is pretty incredible. Once again, she got 50,000 of her money back in the first year, right? $258,000 payback on this note. Pretty good. So the three main approaches that we covered. First of all, buying performing notes. You can buy them for immediate cash flow, or you can sell a partial and use a leveraging technique. You can use a cash flow technique or a wealth technique. Just like we talked about you can convert rentals to notes. Thirdly, you can buy a non-performing note and turn it into a performing note, or you can foreclose and end up with the property. Right? So those are the three, that's the carousel of things that we've covered tonight. There's more. There's more things that you can do, but it gives you a pretty good sense of how understanding notes changes your perspective and what your opportunities are. So who is this for? You want to grow net worth. You want to increase your passive income. You want to have a strategy that works in up markets and in down markets. I've got 44 years to say that. You want to have a strategy you can get to your spouse, your kids, and your family members involved in, and that's what's happened to us. All three of my kids, while they do something else for a day job, they all are invested in love the business. So here's what we believe the roadmap is. Number one is learn the basics of note investing. That's what we're going to do tonight. And that's where I'm going to offer you the next opportunity to progress in what that looks like. Number two, develop your note investing strategy. What is your strategy that it might work for you? And then lastly is to start building a portfolio of notes. And the portfolio, I believe, is the key word here because it's a matter of doing it, not having intellectual knowledge you never act on. That's why our Done For You has been so valuable, because we help people do the things that are the most difficult for them to really get started, right? Find the notes, evaluate them, those type things. So next steps. You are invited to a free one-time implementation session to learn if note investing can benefit your business. I think these are the key words here. Learn if you can benefit, right? What does this look like? Well, next Wednesday, December 11th, from 11 a.m. to 1 p.m., this is Central Time. This is my time zone, Dallas. We are going to have a live virtual cast. So we're going to be with you. We're going to be live, but it'll be virtual. So it's like tonight, and we're going to do this, and then we're going to just take this to a much deeper level. By the end of this session, you'll learn which path you could benefit you the most, whether it's creating notes, investing in notes, most important steps you can grow your net worth through this year, and of course, most importantly, 2025 in the future. When you come and attend this webinar and stay till the end, we are going to give you a tremendous amount of leave behind materials, things that are like guide maps and workflow maps and the things like that. All the things that we've kind of mentioned, the dollar down model, what does that workflow look like? The sell map, all of these things that your mind is going 100 miles an hour. Well, how could I do this? And how could it work? So we want to kind of leave you with things that like clean this up for you. This is a book that I've written that has the 150 most common questions I've ever been asked about notes. Oh, by the way, the answer's in this book. It's called Ask Eddie. right? And so we're also going to give you another white paper, which is a game changer for self-directed retirement accounts. Why partials are a game changer. This is an Excel chart that is baked in the things that lets you calculate and analyze a partial. The blue is the partial sale, the orange is the entire note. What happens if it pays off early? What do I get? What do they get? What would that look like? What if I sold more months? What if I sold less months? And so it's a good way for you to play with the numbers and kind of evaluate where you would be in a deal in a situation. There are a lot of people that are invested in real estate right now that are not in a good situation, right? Real estate can be very kind to you, and real estate can be not so kind. I'm going to say to you that you don't have to worry, that I believe that there are perfect timing for many different strategies. And I will tell you with 1,000% integrity and confidence, I believe that we're in a cycle right now. So y'all know how that works. It's a QR code. You hold your phone up and you can register there. If you don't want to do that, you can just simply type in the URL at the bottom, noteschool.com/protect, and it's going to take you to this special registration. This is not a class for everybody. This is a class we're offering to you guys. And so let's talk about it. Like, what does this mean? You may or not know if you want to attend. That's fair. So I say option number one is just stay where you are. Like, you don't have to do anything. It's America. You can go do what you want to, right? Number two is figure everything out for yourself. Um, Nothing wrong with that. It's just not a very good compression of time, right? And then number three would be to attend next Wednesday and see if this strategy makes sense for you. So come hang out with us a little bit. Let's go down the road. Let's see what this looks like. We want to make sure that you think it's a fit. We don't want to offer you training unless you know, hey, I'm interested in this. I like this. I like it. I think you can tell that, but I want to make sure you like it. And we're going to provide you a lot of tools of the trade, right? We're going to provide you a lot of leave behind materials. So here's how you do it. You're going to go to that website. It's going to be pretty simple. You're going to type in your name. We're going to ask you for just a little bit of information. All you guys know how this works. There's the QR code. And if for some reason you can't make that time, my team will work with you and we will give you another session that we can provide you with. But you're going to need to register for this in order for us to help you get connected. It is not there's two things I'd say about this: show up and like show up, because we're going to go pretty fast. We're going to cover a lot of information. It's going to be difficult to multitask. And if you think this could change your life, it'll be about a 2-hour commitment that's worth it. That's what the landing page is going to look like when you get there. And once again, you see the two different ways to do it, which will be noteschool.com and then also the QR code. And here's what I'm going to say to you. Those steps are intimidating. Those steps are intimidating because you're stepping off into something you haven't done. You're stepping off into something and you want to be confident, and it's going to take a little bit of something for you to go do that. We are very cognizant of a compression of time to give you what you need the fastest you need it, like the AI version of it. You get what I'm saying? It's how do you get the components that matter, and we're pretty committed to doing that, and that's how it works. Don,
Right here.
how you doing,
Hey,
sir?
that was pretty quick.
Well, it was a lot of information, wasn't it?
It was but I think you covered really, really good information. Let's go to the questions.
Okay.
Mark is, and if you have questions, please, we want to hear from you. Um, Mark is asking, what are the tax implications for the note investor?
Well, there's not depreciation, but I'm going to remind you, Don, that depreciation is a tax deferral. It's not a tax forgiveness, right?
Correct.
Secondly, there are advantages in selling notes. Like if you sell a partial, you changed how the note is taxed. So there's some tax hacks. I won't get into all of the details tonight, but there's definitely some tax hacks with notes that most people don't think about. I just happen to bought 50,000 notes, so I've been asked about a zillion tax questions about
Okay.
it.
Sure.
So there's some advantages there that could somebody can learn to really change how their income is taxed and how they position and sell the note.
Okay, and Mark, it also depends on how you're investing. If you're investing with an IRA, well, okay, that would be different than if you're investing with your own name or in an LLC or in a Coverdale or in a. It would also now, Mark, can businesses? Let's say most businesses have a little cash sitting around. Could businesses also purchase cash or purchase notes?
Yes, sir. I bought thousand, way more in my business account than I have in my retirement account.
Ah, so Mark, that would change that too. If your business is taxed as an S corp, the income would be taxed, as an S. So, so you're asking a question. It really depends, Mark. So I don't know how to answer that. It's going to be taxed back to the owner, whoever that is. Mitchell is asking, how are the opportunities underwritten or risk assessed? Let's handle that question from Mitchell first.
Well, one of the things that we go through when we put somebody through a whole class with us is we go through what we've learned after 45 years of doing this. Like when is a loan likely to pay? When is it likely to become high risk and you kind of know it may not pay? Like what characteristics of a loan have we learned over time that are the in what order of risk characteristics? And so we go through that. So let me just tell you this, Don. The simplest answer is this. I buy notes on good properties. I do not buy notes on junk properties. If it's land or if it's houses, I'm telling you, don't call Eddie Speed if you got a note on a piece of junk property because
Got
I'm
it.
out. Secondly, I'm saying that that obviously we evaluate the credit and the ability of the borrower to pay, right? And there's various ways that we've learned over years that are the most accurate ways of doing that. But those are really the two things is we call it the payments are sticky, right? They pay long term.
Okay, so to follow up with that, he's saying if banks don't loan on to borrowers, is it a good risk? What's the default rate on the 50,000 notes you've purchased?
Default rate has been on loans that we bought like that has been about 3%, which is pretty incredible. That's pretty close to Fannie Mae's. Listen, just because you can't qualify for a Fannie Mae Freddie Mac loan, that doesn't make you bad. You know, go drive to your work tomorrow morning and go look at the people around you that are self-employed, the people that make a commission, the people that aren't just a W-2 employee, the people that haven't had the same job for the last 2 years. Like all of that doesn't make you high risk. Fannie Mae and Freddie Mac have already established their index was 185 before the virus, their risk index, and now they're at 100. You think that everybody they've cut out is like super high risk, or you think they've left some people behind? That's how we look at it.
Okay, good. Um, how difficult is the foreclosure process? If you have to foreclose, is it not easy to foreclose on an owner occupied property?
So it very much determined by state. The most common states that we buy in, ironically, are the states that are the most easy to foreclose in. Although our default rate is not high at all, but we buy in Texas and we buy in Georgia and we buy in various places like that where they are statutory foreclosure processes, which means I don't even have to go to court to be able to foreclose, right? So the states that are going to be the riskiest to foreclose in, like you might imagine, the Northeast, we don't buy a lot of loans up there. I don't say we won't buy any because there's other redeeming factors to a loan that give me a sense of the likelihood I'll get paid. But yes, we do pay attention to the difficulty in foreclosure process.
What about California? How difficult is that?
It's actually not too bad.
Is that right?
Mhm.
Okay. Well, okay. So students, you're not. I see a lot of you on the call, but a lot of you haven't asked your questions. Eddie, when I went down to your expo, I was so impressed with the quality of the students that were there. They were asking really, really good questions. They were very engaged. Uh, I didn't meet anybody that didn't have multiple notes, and some of them have been with you a very, very long time, 10 and
Yes.
20 years.
Yes.
All right, Mitchell, how do the loan applications come in?
Well, we're buying existing notes. So we're buying notes that are in existence. And you got to remember, I had about an hour tonight to share a great big story, right? Don, I think it's probably safe to say I'm the most recognizable person in the seller finance industry. I'm in three or four of the largest real estate masterminds, which probably encompass most of the top 500 house buyers, right? I've known your old friend Gene and a lot of people. This industry has been around for decades and decades, right? They would say Eddie's the seller finance guy, right? So I set up the seller finance system for home investors and started in 1990, the ugly house guys, right?
Yeah.
So I work with real estate investors and I give them a recipe and a formula of how to make notes. I show them underwriting techniques. I hook them up with underwriters. I hook them up with special servicers and closers. I take seller financing and I basically kind of paste mortgage banking over the top of it. So they're making loans that I like the most. That's how I've done 50,000 deals is I
Okay.
help them scale their business. So you got to understand there's about 100,000 seller finance notes created every year. I only want to buy 1,000 or two. I don't want to go buy every note that's created out there, but I want to go buy the best notes that are in the market, and I kind of control the environment to make sure that I can do that. That's what I'm known for. I have a long reputation of doing that.
And
So
how
as far
much
as how the loan applications come in, somebody would be buying a loan that we have already bought and it's in existence.
what if I don't have enough money to buy a whole note? Can I buy a partial? Can
You
I
can,
buy, I mean, how much money do I have to invest in notes?
well, there's some point, like I want to be clear about this. When somebody says money, we instantly say resources. What kind of resources does someone have and how can they do this? I mean, there's people that can easily go get a business line of credit for $250,000. There's somebody else that has a rich uncle. There's somebody else that there's all kind of ways that people can do this, right? Note School is not a home for people. We're not the old real estate seminar salesman that says if you're broke and you got bad credit and you're like, we're not soliciting that. So
Okay.
not everybody fits notes, but I would say to you that we are very good at showing people how to build resources to do notes. When I started in the business, I was living in a 10 by 40 mobile home, about 40 years old. That's the
Okay.
truth. But I did it because the guys that taught me the business taught me ways to use the business without my personal money.
Okay. Good. why do you guys mainly buy existing notes? Because you can buy them at a discount? Is that why?
Yes, sir.
Is that, okay. Well, that's pretty clear. Okay. What are the typical sellers of existing notes?
95% of the notes I buy are from professional real estate investors.
Okay.
Hmm.
Not from banks.
No, bank notes at the moment are just not a bargain buy. I mean, there's been cycles that I did buy discounted notes from banks, but right now that's not the pond I'm fishing in.
Okay. Can we turn mortgages on our own rentals into notes?
Yes,
Well,
sir,
yes.
absolutely. That's the whole model I just showed people how to do.
Yeah. How would this be different than a contract for deed?
Well, a contract for deed is a seller finance transaction. Um, there are reasons that I might suggest you do a contract for deed, but there are more reasons I'm going to say that I'm not going to recommend you do a contract for deed. It's kind of a myth. It's kind of a real estate myth. That's what people, yeah, this is a land contract or a contract for deed. And I'm like, yeah, I know. I bought 20,000 of them. I know but I want you to paper it the best you can paper it. And not in every situation, but in most situations, a contract for deed is not the best way to paper it. It will defy what you've probably been told, but I'm
Okay,
fairly
so
seasoned.
K through five for this for people that aren't real estate investors. Describe what a contract for deed
A
is.
contract for deed is just like when you buy your car, you don't get full title to it until you pay for your car,
Okay,
right? You don't get title to the property until you pay for it. So it's a contract that they will give you a deed to the property at a future date.
okay,
And the reason people feel like it's better is they think they'll never have to foreclose. But most state statutes have changed where if people have an equitable interest in their property, then you have to foreclose it to remove their equitable interest. So this is a little bit of a bunny trail to go down, but you know, we're very familiar with it. I think as somebody progresses down the road with us, we'll give them very accurate, detailed information drawing a distinction between this is a good choice in this unique situation, this is a good choice. Land contracts are going to be less common than just a regular note in a mortgage or a note in a deed of trust.
okay. Now, Eddie, you know that we are asset protection geeks, and
Yes,
I
sir.
look at notes very, very differently than I look at owning the deed to the property. If you have the deed, you have the ultimate risk.
Yes, sir.
The mortgage, if my home has a mortgage on it and there's a slip and fall, they might sue me, but they're not going to sue the note holder.
That's correct.
So protecting notes is a much easier process. So generally, we have one holding company that owns a whole bunch of notes. Um, Syndications, it might own bank accounts, brokerage accounts, but those we consider to be low to no risk.
Yes, sir.
Whereas every rental property we put in a separate LLC. Have you found the same thing with your investors?
Well, for the most part, it would be very rare for somebody to perfect a lien or a suit against you if you just have a lien holder's interest in the property. And, and,
Right.
and for the most part, probably a land contract is a lien holder's interest. So we don't look at it so much from a liability perspective as we look at it from a perspective of, you know, um, it's just a little more cumbersome, right? And you
The,
probably have to foreclose anyway, so there's probably not a huge reason that you stick with that. Once again, I go back to the fact that you have a number of people clearly on this call that have probably been around real estate. A lot of people have heard of land contracts or contract for deeds or whatever and stuff, and that used to be kind of the gold standard. But there's for legal reasons today, it doesn't really give you the advantage it used to. So I just I'd rather us still look like a mortgage banker.
in most instances. Yep.
Yes, sir.
Okay. Perfect. 2 questions. Have you used notes to purchase other real estate?
Oh yeah.
And what yield do you try to obtain when you buy existing notes?
The yield for performing notes today that we're delivering to our students is about a 10 to 12% yield, which is very superior in the marketplace. Now, some guy says, well, I want an 18% yield. Okay, well, do you have an 18% tolerance for the risk? Right? So
Okay.
we deliver good quality loans with double digit yields, and we think that's the best in the marketplace that somebody can do. You can go got bank loans, what they call scratch and dent loans today, and they're trading in the mid sevens, 7.5% interest. We're delivering in 10 to 12 for probably a better asset class. So we think we're kind of calling the market the best it can be in that regard.
Okay.
If you're using a
Looks like we've got
leveraging technique like a partial, what's the yield on that? Where you have $1,000 invested, you're going to get 75 back.
infinite. Yeah.
It's pretty crazy, right? Yeah.
Yeah. Okay, we've got a couple Melvins on. So Melvin S is asking, in your example of seller financing, the rent was considered lower than the note. What is the motivation for the buyer to buy versus rent? And when is the rent considerably lower than the note payment?
It
That
is
note
just
in your example did not even include taxes and insurance.
that is 100% true. And that is the market. Go read John Burns's reports. Go read Bigger Pockets reports. That's what the market's doing. People's mortgage payment is about 20 to 50% more than their rent on the same property plus escrows. That's the market. I didn't make the market, I just know the market.
Okay, got it. Deborah, it's good to have Deborah on. Deborah, do you purchase or create notes on commercial properties?
I have, but I'm concerned about commercial right now, so I didn't talk much about commercial tonight. I have a caution flag up, right? Commercial real estate has not been going in the right direction, and I'm not saying we won't do any of it, but we're not necessarily chasing commercial at the moment. Let's just say we're gonna kind of let the barn burn down a little bit.
All right, great. Um, Students, if you've got any more questions, excuse me. That's another reason I'm teaching from home tonight, Eddie. Um,
Kind of down on the weather.
yeah, I had a little bronchitis, and we're just trying to stay away from people a little bit.
Gotcha.
And um, students, I hope you take advantage of that. Would you put up that screen one more time? If they wanted to attend your class next week, this is next Wednesday night, you said, the 11th?
It's Wednesday. It is 11 a.m. to
Okay.
1 a.m. So it's in the middle of the day. And if they register, if there's some reason, our team will work with them once they're registered, and we'll make sure if they're like, hey, I've got a meeting or I've got this and that, you know, we'll get them what they need. But they obviously needs to register in order to do that. And but this is Don, and let me say this, your people are attending this class and like nobody else is attending this class.
Okay. Great. And it looks like Kendall put in the chat screen, so you just go right to that link, noteschool.com/protect,
Yes,
and
sir.
just click on that link, and it's a very simple process.
It
We
is
looked
very
at that
simple.
before, and we can't make it much easier for you.
That's
Um,
what the sign up screen looks like. It's pretty simple.
okay, there you go.
Yeah.
Warren, what about the multifamily compared to commercial, or is it the same?
Well, I went all night without hurting somebody's feelings, Doug, Don.
Okay.
Um, you can't fix the direction that commercial and multifamily is going. You can't fix it. It's already down. Multifamily is down already over 20% already. There have been countless, countless analysis from the Wall Street Journal to hedge funds to economists. Let me be clear about this. There's way difference in listening to a multifamily promoter and listening to somebody that understands economy related to real estate. Because I've learned they have two very different answers about the future. I've been calling the ball on multifamily and commercial for 2 years. I mean, it's you can go fact check me. I've been calling it for 2 years, and I'm telling you that this is not the time to bail off in it.
Can I, expound on that just a little bit? From my
Sure.
perspective, what I'm seeing is the banks are calling, they're not lending to commercial, they're not lending to multifamily. And so the people that can't make their obligations are going and raising funds. And they're promising all kinds of returns, but they're in trouble because they're not, it's almost becoming a pyramid scheme. Um, is that
Don,
is that
can I can
fair?
I say this? Why
Please.
is Warren Buffett willing to sit on so much cash and some apartment syndicator just can't stand it? They got to go do the next deal.
Yeah. Yeah. Okay, got it. Faith is saying, what's a mortgage note? How does it differ from a mortgage?
It's the same thing. When you go to a title company and you sign to buy a house and you get a mortgage, you're going to sign a note. The note is a promise to pay. It's the obligation to pay. To make it secured by real estate, you're going to sign a mortgage or a deed of trust, right? So they're brother and sister documents. This is the promise to pay, the note, and this is the what makes it secured by real estate, which is the mortgage or the deed of trust. That's an excellent question.
Okay, thank you, Faith, for asking that. Menchie, good to see you tonight. I hope you and Noam are doing well. I already registered for the class, but I'm still in the Philippines on that day. She travels a lot, which is the 14 hours ahead of Central Time, which will bring me to 1 a.m. At the class. How can I have access to the class if I don't want to wake up at 1 a.m. in the Philippines?
If you'll register and let my team know, I'll promise you they'll work with you.
Okay, great. All right, Deborah, can we use LLC to own the note and have the members of the LLC be the IRA, the SEP, or the HSA accounts? Can I step in on that? And the
Yes,
answer is
sir.
yes, but when you're using qualified plans, you can't add additional funds to it ever down the road. And so if the IRA is going to contribute $50,000, we can't change. Normally, in an LLC operating agreement, you could change the terms. One partner adds a little bit more, another add. If you're using HSA, SEPs, IRAs, if you're using those types of accounts, whatever the initial contribution is has to stay the same.
Yeah.
Um, and there are some, Deborah. Um, you can call me tomorrow about this, but it's a lot more rules if you're using that. So the answer is yes, you could, but could you buy the note and have it separated without the LLC, Eddie?
Well, I think you and I talked about this, Don. My wife uses a trust, right?
Sure.
So all of our retirement investing is through a trust. So think in terms of this is the trust, okay? And our IRA owns the trust. And I had a glass of tea earlier, and the only the ice is left in there, but you can hear it, right?
Right.
The trust is the vehicle, but the ice is the asset. You got what I'm saying? It's so we use a trust like you use an LLC, and I'm not going to override anything you say about that because I'm not the expert you are. But my
Okay.
wife can have a trust with our IRA accounts, our kids' IRA accounts, our grandkids' covered allocation accounts, and they can make one investment. And that same little partial trick you saw can do it with multiple accounts within one investment.
Okay.
Agreed, you can't add money to it.
Okay. So, Deborah, the answer is yes, but it becomes difficult. And an IRA specialist, like, I don't know, whoever you're working with, the IRA Club or Jill Banner and iPlan Group or Quest or whoever, would be able to tell you the rules a lot better than I could. But the answer is yes, you could use an LLC and have them be the members. Okay,
Yes, sir.
Susan, is the IRA trust a statutory trust or just a regular trust? Um, Eddie, what are you using?
It's
Are
a
you
regular
using
trust.
regular revocable living trust?
Yes, sir.
Okay, okay,
Quincy gave my wife the architecture for all this.
okay.
Yeah,
And he's talking Quincy Long from Quest Trust, and very, very well respected in the industry. And um,
yeah,
I've been able to teach with Quincy a couple times, and what an honor! Yeah,
yeah.
remarkable. Eddie, you had such remarkable talent at your expo. I'm always blown away,
Thank you.
and love to share the stage with some of your people. Anyway, students, with that, we're going to conclude. I hope this has been helpful. Please click on that link. Yes, Quest Trust was sold. Um, yes, they are going away. But we still love the people
Yeah,
who
whether Quincy
were,
still owns Quest or not, it doesn't take any of his knowledge or experience away.
yeah,
So we
and
life moves on, but we were my wife has been highly influenced by Don by a number of people that you and I have both learned and been influenced from, and we note investing is I think one of the very single best things you can do with tax advantage accounts.
you know what? Thank you for that. So, students, take advantage of that class. Um, I, again, the opportunity is there. We appreciate you being on. We appreciate your the students. We appreciate you being on and your questions throughout the thing. So we encourage you to do that. Any closing remarks, Eddie, before we wrap this up tonight?
It's an honor to share the stage with you, sir.
It is my honor to have you, Eddie. We appreciate you. Students, have a happy holiday. We've got one more webinar in the series. It'll be next week on cost segregation. We hope you join us for that. And we appreciate your very kind remarks. Thank you. Have a
Uh,
great night. Bye bye.
Thank you.